And last month, we started off with a correction over signal, right? And we discussed how there was likely to be a rally into year end. And we were kind of looking at that rally, trying to measure how strong it was, how many breadth thrusts, a lot of developments could help tell whether that's something that's going to be more of a sustained rally or whether it's just going to be kind of a multi-month rally that gets us into the same problems we've been having. So that's where we were last month. Right now, the market's rallied quite a bit off the correction over signal from early November, but it's currently pricing in a lot of things that seem difficult. They're not impossible to have happen, but it's a very difficult scenario. The market's currently pricing in over 110 basis points of rate cuts for 2024. At the same time, the earnings estimates are pricing in 12% plus earnings growth and a soft landing. It's not impossible, but that's an extremely narrow path and an improbable combination. There has not been rate cutting of the amount that is expected over the next year that has accompanied earnings growth in the last 50 years. So generally, when the Fed cuts rates as much as markets are expecting, it's in response to slower growth that is negatively impacting earnings growth. That's not what the market is pricing in. So we want to kind of understand that the market has expectations that are going to be very difficult, not impossible, but difficult to sustain, and kind of keep our mind open to, okay, maybe we're going to see some parts of those expectations unravel at some point in the first half of 2024. We have seen the NFP labor report was stronger on Friday. Unemployment came down almost exclusively due to an increase in labor participation. And the headline number was really quite strong, heavily due to the end of strikes. And so when you look beneath the surface, I would say that the report is strong, but not as strong as the headline numbers make you think. And there are still some components of that report that are a little bit worrisome. So we want to understand, first of all, that the labor market is one of the most lagging indicators. It's a lagging indicator, but it's also one of the most of all lagging indicators lagging. We do still see bankruptcies rising to recessionary levels. So we've had a breakout in bankruptcies. We also see credit card delinquencies rising to near recessionary levels, some of them even reaching the levels that we had in the last recession. And we also see job openings falling off. And you can see that job openings falling off has been a pretty good precursor for a negative stock market environment in the past. Now we're falling off in job openings from really high levels, but the market is just going the other way. That's happened for a while in other periods, but eventually the market caught up to those. So we've got some things that are still a little bit of concerning. So we have to keep our mind open in 2024 for the potential that the soft landing is going to happen, but it's not going to be so soft as to allow double-digit earnings growth, or for growth not to be soft enough to lead the Fed to cut rates very aggressively, because usually when the Fed cuts rates as much as we've talked about, as we've said, it's because of the slowdown in growth. If growth doesn't slow down that much, why are they going to cut rates that much? And then we also even have to think about the double whammy. We get both the hard landings and earnings growth disappointment. That is, and the only part of the scenario that comes true are the rate cuts, and the rate cuts come not for good reasons for stock, but for bad reasons. And you have to remember, when the Fed begins to cut rates in response to slowing earnings growth and the slowing economic growth, that's usually very bad for stocks, and it's some of the weakest part of the market environment. So we've got a bunch of kind of question marks out there still. So this is a good sort of, I've got a couple of these that I want you to see. The market's getting ahead of itself. It's really expecting a lot lower rates very quickly, only because of inflation falling. We really haven't had the Fed cut rates as drastically as the market is expecting, without growth falling and with just inflation falling. The other thing that we talked about last month was this mid-1940s analog, where had at the end of World War II, there was a ton of stimulus during World War II for weapons and everything else, all the war spending. And then there was also a ton of stimulus to consumers coming out of that after the war ended, with GI bills and a lot of things to try to get soldiers returning home to participate in the economy, have some consumable money, and be able to kind of launch that economy. And that combination led to this situation where we had inverted yield curves, and we had leading economic indicators declining below zero to forecast recession. But that recession just took a very long time to develop, much longer than any other period. And so during that period, they came up with this idea, the Wall Street Journal, they called it a soft landing, right? That's really where that concept started. And so that's the first time we've ever seen any blip in this soft landing scenario. And then since then, we've had 17 other spikes in soft landing being in major media stories. And 16 of those led to recession. The 17th one was in the mid-1990s, was much smaller than we've had the spike recently. But you just want to understand that typically in 16 out of 17 cases, when you see a spike in soft landing in the media, it comes before a recession. It's really only been one time that hasn't been the case. Excuse me for a second. All right. So we've gone much higher than we did in the 90s. This spike in soft landing doesn't necessarily tell us a soft landing is coming. It tells us that there's potential for recession that we want to watch out for. Okay, and then we had some things, again, beneath the surface in the NFP report that were still saying economic weakness is coming up. Temporary help in the services sector coming off. You can see that's come off prior to recession in other instances where it's come off to this degree. And then we really have cyclical jobs growth coming off to near zero. And when it's fallen below zero in the past, that's sort of suggested recession ahead. So we got still some things, even with that supposedly strong labor market, maybe they tell us, look, market's not going to be focusing on softness for a while. We got good room to the end of the year, certainly, particularly if we can get through the FOMC meeting this week and we can get through the CPI report without big negatives. We can still have a good run through the January 18 or so when we have this seasonal period that comes to an end. But afterwards, as we start getting into 2024, we've still got some growth concerns and we have expectations that just don't really add up in any instances of the past. The other thing, and we talked about it last time, we talked about how the correction in the stock market, here's the S&P in this top panel, and here's TNX, the 10-year treasury yield in the bottom panel. And we talked about how the correction off of the July peak really came once TNX broke out of a many-month range to the upside above this 4.09%. That's really when the stock market started to correct. And that correction has continued till we got a nice double top breakdown in TNX rates. That's really when rates started coming down, that's when the stock market really took off. That's where we get our correction over signal. So one thing I want people to understand is that this rally's been heavily dependent on this decline in the long bond yield, but it really hit an important support point last week, and this 4.09 from where that original breakout occurred, and it's bounced significantly. If we close over like 4.4%, that's likely to be problematic for stocks going forward. Conversely, if we do close below this 4 to 4.09 in this area, that's a real good sign that we've got more to go for the bond market. Rates are coming down lower, and it gives stocks longer to go higher and more room to go higher. So really want to keep our eye on the TNX rate still.